Hi guys, a very good afternoon to all of y'all. Today we'll be looking at another new and a very most important topic which is known as IAS 36 impairment of assets. In terms of its weightage, this will be tested under your MCQ or an OTQ. In addition to that, it will be tested compulsorily in your company accounts adjustments. Okay, so when you are studying, make sure you prioritize this particular standard since this is highly tested. Okay, so before we jump into the topic, let us, as usual, go into an illustrative example. Hopefully, my screen is visible. Hopefully, my screen is visible. Before I start, I would like to tell you all, I would like to stress on a specific word that will be throughout used in your standard. Okay, so give me a minute. Okay, this particular word, recoverable amount. Now, this is a term that is to be used throughout your entire IAS 36 standard. Now, you all can ask, what is the meaning of this? Recoverable amount is the maximum benefit from an asset. Okay, it's the maximum benefit from an asset. For an example, let us take this. Say you own this motor vehicle, right? And which is used in your business throughout. Now, how do I get the maximum benefit from this motor vehicle? How do you think that I could get the maximum benefit from this motor vehicle? I could either sell it to a third party and in exchange I could get cash. So cash is the maximum benefit that I could get. That is one. Or the maximum benefit can be generated by me using it in my business operations daily. You all know, if I use my motor vehicles in my business operations, it will help me transport my goods and services to my customers, final end-to-end customers, who will give me future cash flows, which is your future profits or future losses. Or another perspective of how do I generate by using that asset in my businesses? You all know, as that asset nears its useful life, you will have to sell it as scrap. So then, when you are selling, ideally that will also generate your with cash. So this is the meaning of your recoverable amount, the maximum benefit that you can generate when you sell it or when you use it in your business operations. Okay. Now I'm going to pitch in how does IAS 36 come in. See, when the maximum benefit, when you sell it to a third party or whether you use it in the business, you can only generate 15 million. You can sell this motor vehicle in the market for only 15 million, or you can use it in your business and generate only 15 million. But what you have done is you have gone and reported or you have gone and presented under a statement of financial position the carrying value as 23 million. Don't you all think this is an overstatement? Don't you all think this is an overstatement? What do I mean by overstatement? When the asset is valued in the market only at 15 million, you have gone and recorded it at 23 million. So don't you all think that you all are overstating the asset by 8 million? This is not allowed at any cost, according to your prudence concept. What does prudence concept say? Never overstate, never understate. Show all the assets as it is, as its market value. Present it as its market value, right? So hopefully you are clear. Hopefully you all are clear. Again, I'm explaining it to you all. 15 million is the amount that I could generate by either selling it to a third party and getting cash, or 15 million is the amount that I could use it in my business and generate profits. That's the maximum benefit, which is known as your recoverable value. But what we have done as accountants, we went and recorded in our books 23 million as at your reporting date. So you all have overstated. You all have overstated your assets by 8 million. Now this is not allowed. So what you all need to do is you all need to bring it back to its original market value. So that is where IAS 36 impairment expense comes into play. Okay, that is where IAS 36 impairments comes into play. So the double entry would be you all need to reduce the asset. You all need to reduce the assets carrying value by 8 million. So your property, plant and equipment will be a credit. Okay, why? Because you're planning on reducing. And you will be debiting impairment expense. Why? Because if you debit it, that is an expense that is to be charged in your profit or loss of 8 million. So this is the double entry for that relevant transaction. This is a double entry for that relevant transaction. You debit impairment expense in your P&L and you credit your property, plant and equipment. The reason why you're crediting your property, plant and equipment is to bring it back to its actual market or recoverable value. Okay. Now, for most of your first doubt would be, why is IAS bringing up this standard? Why did IAS pitch this standard in? Okay, there is a reason for that. There's a reason for that. See, normally, according to any of the standards, you should never overstate an asset or a liability or an equity. Why? Because if you overstate them, investors will be misleaded. Right? Always show them at their actual market value. In this particular instance, in this example that I bought in, the actual market value was 15 million. Why are you going and showing them at 23 million? Why is there an overestimated? Why are you overstating it? Right? So you need to understand that. Okay. Remember that this is, of course, a prudence concept that you all need to be aware of. No deliberate overstatement or no deliberate understatement. Okay. Now, you all can ask from me, how did I arrive or how did I come up with this recoverable value? You all need to take the higher of fair value minus cost to sell. Now, fair value is your markup price minus any cost incurred to sell. That is number one. Number two is your value in use. Right? What do I mean by value in use? Give me a minute. Let me explain this concept a bit, and after that, I'll explain each and every term properly. Okay. So you all know recoverable value is the maximum benefit from that particular asset. You can either sell it or you can use it in your business. Right? You need to take the highest. You need to take the highest. For an example, let us tell. For an example, let me tell you. Fair value minus cost to sell is about 70 million. Okay, fair value minus cost to sell is about 70 million. Value in use is only giving you all 50 million. So out of these two, which is your maximum? Which is the highest benefit? I would say fair value is going to give you all the maximum benefit. So this would be your recoverable value. Always understand your recoverable value is the maximum benefit from your fair value minus cost to sell or your value in use. Okay. Now, fair value minus cost to sell, I of course don't need to explain it. You all know. Okay. So your market selling price is 80 million. To sell that particular asset, you all need to pay agent fees, advertising, all of those. Those cost about 10 million. So your net fair value is 70 million. Okay. This is if you all are selling that asset and generating cash. There is another new term called as value in use. What does this mean? What does this mean? See, what do I mean value in use is, you all know recoverable value can be generated in two aspects. One is you could sell it. That is this fellow. That is this fellow. You can sell it to a third party and generate cash. What do I mean by value in use is, what do I mean by value in use is, I am using that asset in my business. See, I'm using the asset in my business to generate future incomes or profits. What do I mean is this one. Here it is. This part. If that asset is used in your business operations to produce future profits or losses, that is known as your value in use. That is known as your value in use. Okay. So you all can ask, how do I compute it? Give me a minute. But I would like to give you all a disclaimer as well. Most of the times, your examiner is going to give this particular amount. Okay. And in case if he does not give you all this particular amount, I will tell you all how do you all compute it. I'll tell you all how do you all compute it. Now, mm, yeah. With what we have learned, let us try to do an example or an activity soon. Okay. They want us to find out the impairment loss for each asset as follows. Okay. There are three assets, asset A, B, and C. A has a carrying amount of 100, B has a carrying amount of 150, and C has a carrying amount of 120. Okay, this is directly from the question. Now, you all need to find out the recoverable value. You all need to find out the recoverable value. Let me do for A, and if you all understand it, you all can pause your recordings and watch how to do B and C respectively. In terms of A, the fair value minus sales or selling expenses for A is equivalent to, how much is it? It is 110. They have given in the question itself. Okay. The value in use is only 120. Now, in terms of recoverable value, again, I'm asking you all need to take the highest out of this, right? Because it's the maximum benefit of that asset. So out of this, I feel 120 is going to give me the higher value. 120 is going to give me the higher value. 120 is going to give me the higher value. So that is the recoverable value in terms of option number A. Okay. Now see, your assets carrying value, or you all have gone and presented it in your statement of financial position as 100, but you can sell it in the market for 120. So in this instance, you all do not need to do impairment. Why? Because you all have not overstated the asset. Okay. So now let me show you all the summary also for us to slowly build on this concept a bit by bit. What do I mean by IAS 36 is, when my carrying value is more than my recoverable value, then I need to do impairment. I need to bring in IAS 36. Again, I'm repeating myself. When my carrying value or when the book value of the asset in my SOFP is more than the recoverable value, then you all need to do impairment. Okay. So now looking at option number A, we have correctly identified that the carrying value is only 100, but we can sell it at 120. So here we don't need to do impairment at all. We do not need to do impairment at all. The reason is our carrying value has not overstated the market recoverable value. You all need to understand this properly. Okay. Now, let me do option B as well and I'll leave C for you all. Okay, since it's new, let me do option B as well. In terms of option B, the carrying value we have as accountants, we have gone and recorded at our reporting date as 150. Okay, here it is 150. Now, in terms of recoverable value of option B, which is your fair value minus sales and your value in use. I would say, according to the question, in terms of B, your net realizable value or your fair value minus sales is 125. Right? 125 is your fair value minus sales. What is your value in use? What is your value in use? It is 130. It is 130. Now, in this, again, I'm asking you, what is the maximum benefit among if you sell it or if you use it in your business? I would say in this, 130 is the highest, right? And this amount is generated if I use this asset in my business. I can generate future profits, right? That is a value in use. So my recoverable amount is 130 alone. Here it is. My recoverable amount is maximum 130. Now, again, bringing in your logic again. The maximum amount that I can sell or I can use and generate profits, future profits, is only 130. Is only 130. But our accountants have gone and reported it as 150. Now, in this instance, don't you all think that this has been deliberately misstated? This has been overstated by how much? 20. Right? Since this is deliberately overstated, since your carrying value has exceeded, you see, since your carrying value has exceeded the recoverable value, you all need to do impairment. Okay, let us take this itself again. My carrying value is 150. My recoverable value is only 130. I'll throw it here. Sir. My carrying value is 150, which is greater than 130. Don't y'all think this is wrong? Don't y'all think this is wrong? So then y'all need to impair. Y'all need to impair it by 20 mm. The double entry would be debit impairment expense 20 million and credit your property, plant and equipment by 20 million. Okay, this is what I have done here. Can you see here 20 million? In terms of C also, your carrying amount is only 120 million. You have gone and recorded as 120 million. Okay. In terms of value in use, if you sell it to a third party, you can generate 100. In terms of value in use, you can only generate 90. So out of these two options, which is the highest? Which is the highest maximum benefit in terms of your recoverable value? It is your 100. Yes. See, if I sell this off in the market, I only can generate 100. But our accountants have gone and showed it as 120. So here also, it is again, an overstatement of how much? 20. So this 20 needs to be impaired. The reason why we are doing impairment is to bring it back to its original form, to bring it back to its actual market value, to bring it back to its actual selling price. Okay. So we are done with all of those. Have I missed anything so far? No. Okay. Finally, in terms of this particular note, now most of you all can ask, How does depreciation work? How does depreciation work? Now, do I depreciate based on my carrying value, or do I depreciate based on my new revised carrying value? What do I mean by new revised carrying value is, for option number B, the new revised carrying value would be 130 because that's the maximum amount or maximum benefit. For option number C, the new revised carrying amount would be only 100, right? Because that is the amount that is the maximum benefit. Okay. So you all can ask, using which amount do I need to calculate depreciation? Is it using the normal carrying value or is it using the revised carrying? Logically think, if your carrying value is overstated, then obviously the depreciation that is being charged on that overstated carrying value is also wrong. Is also wrong. Why? Because your real carrying value is overstated. Okay. So what I need to do is, yes, let me take this question itself. Let me take this question itself. Look at this. Let me take this question itself. My carrying value is 23 million, which I have gone and recorded. I have gone and recorded my carrying value is 23 million. But I actually can sell it in the market for a maximum amount of 15 million. So don't all think that this is an overstate. Therefore, therefore, I need to charge depreciation not on 23 million. I need to charge depreciation on 15 million only. The reason is 23 million is an overstated amount. Anything that I charge on an overstated amount, depreciation will go wrong. Depreciation will be calculated in a wrong manner. Okay, that is what I have given here in your note as well. Yes, see, you will only depreciate from the revised carrying value, which is 15 million. Why? Because this 15 million is the correct amount. Your old carrying amount of 23 million was overstated. Okay. So don't ever charge depreciation on your old carrying value. Okay. So here it is. Here it is. How do you all find your carrying? How do you all find your depreciation? Simply your revised carrying value, which in this particular perspective is 15 million divided by the remaining useful life. For an example, let me tell you, 15 million divided by your remaining useful life, take about 5 years remaining, then your depreciation would be 3 million per year. Don't worry, we have questions coming up. Let us look into that once we enter those particular relevant questions. Okay, now let us look into some of the theoretical aspects in terms of this particular standard. Okay, now even though this is not being asked, this was a doubt that is being asked by most of the students. Is my depreciation expense and is my impairment both the same? I would say no, they are not the same. They are two different expenses in your profit or loss. They have two different standards and also they have two different accounting treatments. Never ever go and consider that depreciation is the same as your impairment. Both are two different items. Okay. How do I differentiate it? How do I differentiate it? Here it is. This is the difference. See, as per depreciation standard itself, it is a systematic allocation of your cost over the useful life. Say my total cost I initially incurred was 10,000 and useful life is 10 years. Each and every year I need to pay depreciation. Until the final 10th year, I will be paying depreciation, right? Evenly throughout the entire 10 years from year 1 to year 10. If that asset has been used in my business, I need to pay depreciation, right? I cannot say that for the next year I will not charge depreciation and the year after that I will be charging again depreciation. No, IAS 16 does not allow. You need to charge depreciation throughout this entire 10 years at 1,000 each year. Now, in terms of my impairment is not done always. Impairment is not done annually. Okay, that is what we are going to learn in the top. Okay, impairment is only done if there is an indication of impairment. If there is an indication of impairment. For an example, if there is a sudden fall in your asset's market value or a recoverable value, then you need to do impairment. Okay, so that is the difference between depreciation and an impairment. In terms of depreciation, each and every year it is compulsory, it is required for you all to do depreciation. Impairment is also required, but if there is an indication for the impairment, if there is no indication, then you all don't need to charge impairment at all. Simple as that. Okay. Now, now, you all know depreciation each and every year. If I use that asset in my business, each and every year, I need to charge depreciation as an expense. I cannot omit it, I cannot avoid it. Now, in terms of impairment, you all can be having a doubt. Is impairment an annual expense? I would say no. Impairment is not an annual expense. Only if you have an indicator, only if you have an indicator that your market value is falling or your recoverable value is falling, then you all need to do impairment. Again, understand, again, listen to me. What I'm trying to say is impairment is not annually, it is not mandatory to do it yearly. If there is an indication only, then you all need to do or test impairment. Okay. Now, in terms of indicators, there are internal indicators as well as there are external indicators. Internal means within your organization, external means outside your organization. Okay. If your asset is damaged or obsolete, okay. For an example, say you all were using this machine in your factory and suddenly there was a fire and the entire machine was destroyed. So then that will affect the machine's selling price. Obviously, right? Okay. I was using this, consider this as a car. I was using this in my business to deliver my goods and services. Say suddenly they introduce a new version of this particular car, which is hybrid, right? Then obviously this is becoming obsolete or it's becoming old, right? So then the market value of this car will reduce. Okay. Finally, in terms of financial performance of the asset has dropped. Okay. Now this, I will tell you all, this is a sure shot question that you all can be asked if it's tested in MCQ. They will ask, they will give you all four options. They will give you all four options and identify which are the internal factors or identify which are not the external factors. Examiner will term it like that. Okay. In terms of financial performance of asset has dropped. For an example, take this to be a machine. I bought this machine 5 years back with the intention that this machine can be used to produce 1,000 units per hour. But within 2 years, I have found out this machine is a waste. It is only producing 200 units per hour, right? So the financial performance of this machine has dropped, right? So which is obviously going to affect the market value. Don't you all think if I go and sell this off to another person, he will tell, no, I don't want you all to pay that particular amount. I don't want you all to pay the market value because why? Your machine does not produce 1,000 units per hour. It's only just producing 200. Logically think. Okay. Now, in terms of external factors, external factors are, as I told you before, external factors are factors that are affected outside the organization. For example, they could be your technology, your legal, or your economic. I will give you all each and everything one example. I told you all. Say for an example, earlier you all were using phones in your business. okay, to regularly call your customers. You all were using earlier iPhone 6. Now, suddenly there was a change. Each and every year, you all know that iPhone releases a new product. So then that technology becomes obsolete. My last year iPhone 6 was at 35,000. The next year, when iPhone 7 is being released, my iPhone will be valued at, say, about 15,000, something of that sort. Number two, number two, in terms of legal, sometimes government imposes import bans. Okay, say that this is the motor vehicle that I imported 3 years back for my business. Right, when I imported, it was say about 500,000 LKR. But now the same specific vehicle, government is imposing a government restriction or an import ban that you cannot bring this hereafter into the country. So then obviously my market value will reduce, will reduce. Okay. In terms of economic, let me come there. Let me come there. Give me a minute. I'll show you. In terms of economic, you all need to recall your foundation level knowledge. Okay. And I'll try to sync your foundation with your financial reporting. Hopefully I'll remember, hopefully I'll remember, we learned we learned a concept called as value in use. We learned a concept called as value in use. And I told you most of the times examiner will be giving that value in use, but sometimes we need to calculate it in our accounting. Okay, and this is how we do it. This is how we do it. And this is how I'm planning on bringing the economic factor into play. This is how I'm planning on bringing economic factor into play. Sorry, give me a minute. What do I mean by economic factor is interest rates. You all know to calculate value in use, you all need interest rate. Okay. First of all, what is value in use? Value in use is, it is. It will tell us, it will tell us what is the present value of my future cash flows. Say for the next 5 years, I'm planning on generating 100 a year, 200 a year, 300 a year. You will find out the present value using your value in use format. Okay. So hopefully I'll remember this chart. Hopefully I'll remember this chart. In your management accounting, F9, all of this will be used. You all will be having your years, you all will be having your annual future cash flows, and you all will be having something called as a discount factor, right? Which is your interest rate, inflation rate, and whatnot. By multiplying your cash flows into your discounting factor, you all will be finding the present value of the future cash flows, right? So this is how we have found out the present values. Now, coming into the factors, external factors. You all need to understand. Just try this, okay? Just pause my recording and try this. I wanted to try this. If my interest rate is increasing from 10 to 20%, can you all see here? My discounter factors are also reducing compared to the discounting factors that have been given at 10%. Then what will happen is my value in money will also reduce. When my interest rate falls, my value in money or value in use will also reduce, right? So obviously when value in use reduces, you all know your recoverable amount will get affected. You all know your recoverable amount will get affected. This is an MCQ related question you all can expect. Okay, don't worry, we have a separate recording where we'll be focusing on separate MCQs from a BPP and Kaplan, and you all could have a look at it. Okay, for now, simply try to understand. Recoverable amount is calculated by two different parts. One is your fair value and another one is your value in use. your value in use will get affected due to this particular economic factor, which is your interest rate. If your interest rate falls, your discounting factor falls. Because of that, your value in use also will fall. Try and see, use the same figures that I've given, and only change your discounting factors. You all will be able to see this final result declining. Okay, simple as it is. Simple as it is. So this factor is about your fair value minus cost to sell, right? How your market value tends to reduce. This third point is about your recoverable value in terms of value in use. Okay, simple as that. Now, finally, in terms of a final theory, I told you all right, impairment is not done annually. Impairment is not done annually. Impairment is only done when there's an indication. But there are some exemptions. There are some exemptions. These three assets, always remember these three assets, you need to do annual impairment at each year end. At each year end, you all need to do annual impairment. Okay. As I told you all earlier, impairment is not to be done annually. If there's an indicator only, we will be doing impairment. Yes, I was 100% correct. But these three are exceptions. These three are exceptions. Each and every year, you all need to do annual impairment at each reporting date for these three type of assets. First of all, try to remember. You all hope you all remember under IAS 38, intangible assets. We studied that there was intangible assets with unlimited useful life, right? So obviously, we did not amortize. Why? Because to amortize, you all need to find out the useful life, right? So since intangible assets did not have useful life, we had to do annual impairment. So this is number one, where you all need to do annual impairment at each reporting date. Number three, intangible asset not yet available for use. What do I mean by this? You all know development will only be capitalized if the entire pirate criteria is being met and if it's ready for mass production. Until that, we will not amortize that development expenditure, right? So then you all can think, then if I'm not amortizing it, what do I need to do? I need to do annual impairment. I need to do annual impairment. Right. And finally, this of course you will be learning under your IFRS 3 standard, but let me tell it here also. We will purchase goodwill, right? When you're acquiring a subsidiary, say you're purchasing a 50% or a 60% of the subsidiary, then you all need to calculate goodwill purchased. And under that, you all need to deduct annual impairment. Okay, don't worry. When we come to that particular part, we will learn. So this is it in terms of your theory.